All right, I think I'm okay now.
Awesome.
Okay. So I'm setting up also the live stream. So Micah, you can also mention to them that this is being live streamed on YouTube. But this is it's on a private page. So people can't really see it, not until they access it.
Gotcha. All right.
This is great. So we'll start in about 2 minutes.
Okay, sounds good.
Hi, Sanjay. I saw that Sanjay just joined in.
All right.
Hello.
Hi, thanks for joining in.
Oh, my pleasure. Is there going to be a recording available later, or I'm kind of in and out? Sorry.
You're good. Yeah. This is recorded. This is going to be recorded. And then we're going to be it is also live streamed on Facebook. I'm sorry, not on Facebook, on YouTube. So
Okay.
you can access it also later.
Oh, very cool. Thanks.
No worries. So we're down with 1 minute. I'll go ahead and hit record. So for everybody's reference, let's do that. Cool. So yes, we're live. It's 4:30 p.m. Pacific Standard Time, and we have our featured speaker, and also with my co-host Micah Hillis. Before everything else, I wanted to welcome everyone, and of course, hello, and it's been a pleasure to have you here, and thank you for attending our today's webinar, which is the tax benefits of real estate investing. And today's webinar is presented to you by Brickstone Investment Group, and I'm Princess Escoto, the co-founder of the group, and I'm thrilled that Micah Hillis, my friend, will be co-hosting with me today, and he's one of our team members, and it's been a joy to moderate this discussion with him. So hi, Micah, and welcome.
Hey, Princess. Thank you. Super glad to be here today. Grateful to be here with you and with our guest, Claire, and of course, just to be a part of Brickstone and all the opportunities within the multifamily space. Before we jump in, just a couple of housekeeping items for everybody. We're going to keep everyone muted throughout the presentation. That way she has a chance to get through all of her material. If you do have questions, though, put them in the chat. We've got a Q&A at the end. There's going to be plenty of time for that. We're going to keep this very interactive. And then also, we're going to be recording this. So if you have to leave or if you miss parts, just drop your email in there. If we don't have it already, put your name, and we'll make sure that we get you the link for the recording and send that out a little bit later. All right. And then lastly, just want to make sure everybody knows it's our goal to provide valuable information here for you guys in these webinars. So I just want to talk about our speaker. She's got a great presentation. One of the things I appreciate about her is her ability to share information in a really relatable way, because we know taxes and numbers aren't always the most exciting thing, but that's why we're super excited to have her with us. She's an expert and she's very good at her thing. She's concise, informative, going to give a lot of opportunities for questions and interaction. But before we hand that over to her, Princess, I'm wondering if you could say a quick word about Brickstone Investment Group.
Yes, definitely. So a quick overview of our group. It's called Brickstone Investment Group. So it was founded by me and my husband, who also joined us in this webinar. We founded it in 2019. So we are both in real estate business in Southern California. We buy apartment buildings here in LA and also out of state, along with our business partners and investors. So we actually we are supposed to close one of the 104 units that we have partnered up with our friends in Georgia. So that's one of the things that we had just worked on or we're working on to close this month. And so our goal is to actually help our first-time investors to get started with their real estate investing portfolio through buying apartment buildings, or sometimes what we call the multifamily, in this business. And I will say multifamily has allowed us to open doors to other people to participate and grow their real estate portfolios. And this is one of those differences of multifamily that appealed to us personally, and is also why we are here to put up in this on this webinar. So at Brickstone, we believe that there is a plenty to go around, and we wanted to share and help as much as we can. So if you wanted to learn more about how or what we do, of course, visit our website, Brickstone Investment Group, and that is actually showing on top of my screen. I don't know which way, but yeah, that's it.
Well said. Thanks, Princess. Let's get started. We're excited to have our first webinar of the year and super excited to be joined with Claire Vazant of Terra Business Solutions. So Terra was started because Claire and her partner Danica kept seeing how badly real estate investors, professionals needed tax service that really understood their unique situations. So this is her specialty. Claire herself, she's got a CPA with 16 years in tax prep and planning, over 20 years in the accounting industry. And in addition to being a certified tax coach, she's got her master's degree in taxation, and she's completing a second master's in international real estate. Claire's worked with all different entity types, from real estate investors, portfolio managers, small business owners, you name it, all right? And of course, she is the tax director and partner at Terra Business Solutions. Claire, thanks so much for joining us. Why don't you take it away from here?
Thank you for the introduction. I do have a slide for my introduction. Most of it you've already said. There's not much else to add here. I am about to complete my last class in my second master's degree. So hopefully that'll all be done, and maybe I'll stay out of school for a while. I don't know. We'll see. I did also put my contact information here. I'll share that again later on if anybody needs it for any follow-up questions. Okay, so the first things I want us to start with is just kind of categorizing real estate before we go into any specific tax rules. It just makes the understanding of the tax rules that we discuss a little bit more relevant and easier to understand. Some of this you may already be familiar with, so it could be review, but basically these are like the main types of real estate that people might invest in that you're going to hear about. I put it into two main categories: residential and commercial. Residential, is pretty self-explanatory: single-family homes, condominiums, detached, attached homes. A new construction can be commercial or residential. A lot of times you're talking about, brand new homes. The difference is, you're going to do a different type of analysis, obviously, because you don't have historical information, sales information, you don't have rental history, anything like that. And they also can be invested in different stages of the development, from anywhere from the raw land in the middle of construction to commercial is pretty much everything else. The first one, multifamily, you might hear it referred sometimes as residential, because obviously the people that are residing there, it's their residential home. But for our purposes, it would be in the commercial bucket, because generally the owners of the multifamily are doing it for either investment or business purpose. I have a little note here for 2 to 4 unit properties, only because for lending purposes, they treat those a little bit different. For lending purposes, a residential mortgage broker could handle a 2 to 4 unit property, but once you go to anything 5 or more, then you'd have to deal with the commercial broker. The lending rules are different, and so on. Then you have retail, office space, industrial, which could be anything from warehouses or storage units, labs. Then you have hotels, and then you have mixed use, which is a combination. So you might have retail space at the bottom, and you may have residential property above or offices up above. And then of course land, you may have farms, ranches, orchards. This could sometimes be the farmer is the landowner, or it could be land that's rented out for those uses. Okay, so again here, this is not all inclusive, but these are common types of real estate investing. Again, I separated this into two main categories, active and passive. This has to do with your level of involvement. Selecting tenants, they have some level of involvement. Same thing with raw land and new construction. There's some involvement in selecting the land, hiring the contractors, things like that. And then you also have a fix and flip investor. And these are the ones that you know, they have the TV shows where they're going and they're buying a property that's in distress and they're fixing it up and then they're selling it for a value. These are typically shorter term investments. And they're also treated differently for tax. So I can elaborate a little bit on that. And then we also have the passive category. Now this is more has to do with, again, you're an investor. You're putting in your money and then you are sharing in the returns in some manner. Most times a passive investor is not involved in the day-to-day management. It's not involved in selecting the properties, improving the properties. So they have minimal to no involvement. The first one I mentioned is a REIT. These are like publicly traded in most cases. It's similar to buying shares in a publicly traded company. It's just that the company's business is real estate investments, and you're getting a dividend off of those. And then you have wholesale. Wholesale, I'm not going to elaborate too much on that. As far as tax purposes, it is treated similar to the fix and flip investor. So I'll discuss that a little bit more. This is basically where you're just sort of a middleman. And I put it in the passive category only because this is something that's referred to as a passive investment. And this is where you're connecting people. So you're connecting the seller with the buyer. So you're finding out what the seller is willing to sell it for. And you're in some cases entering into a contract, but you're not the one actually buying the property. It's mentioned as passive because sometimes it's a side hustle that's somebody spends very little time and they have big returns. For tax purposes, that is generally taxed as if you are actively involved in the business. So I can elaborate on that if anybody has questions. And then you have crowdfunding platforms. This is kind of, it can come in lots of different forms, but oftentimes you need to be an accredited investor, which means you have minimum income requirements and or you have a minimum asset value that you need to have. And this is because they are not like publicly traded. And so it's meant to protect the investors. And so this would include non-traded REITs, partnerships where they're bringing in the investors to buy properties together. Okay, so this one we're talking about passive real estate investments. I'm mainly talking about passive because when somebody's first getting into real estate investing, that's typically what they're doing. So it's very unlikely that they're quitting their job all in one swoop and doing everything in real estate. So generally it's is that you're putting in money and you're getting some good returns and you're not having to go out every day and spend hours and hours to make that money.
Hey, Claire.
Yes.
Sorry, can I stop you for a minute? You kind of lost at some, I think for the last 2 bullet points that you were just talking about. Do you mind repeating that for us, please?
Sure, the sound went out?
Yeah.
Okay, can you hear me okay now?
Yeah, you just lost like for a few seconds.
Okay. Do you want me to just go back to the beginning of the slide?
Sure, please.
Okay. So did you hear, I was talking about majority of real estate investors are passive in nature when they first go into real estate investing.
Yes.
So we're focusing on passive treatment mainly. So when you hear about passive investing, it can have a negative or a positive connotation. So the positive is putting in money and not having to spend every day working in this job in order to get a return, similar to any other type of investment. And it can generate some good cash flows. And for the negative connotation has to do with tax, and I will elaborate that a little bit as we move on. A few things to note as far as tax, how taxes are treated for passive investments. They're not just subject to self-employment tax. Again, this goes back to the fact that you're not working in a business, you're not actively involved in it, you're an investor. So it's not subject to self-employment tax versus if you started a coffee shop, for example, that net income would be subject to an additional tax on top of ordinary income tax, which is about a 15% tax rate. And that is basically equivalent to the payroll taxes that you pay on W-2 withholdings, the Social Security, the Medicare. It's basically having you pay in that same tax, and they can't tax you any other way because you don't get a W-2. So again, real estate investments are not subject to that. The other thing to note, and I can elaborate on this as well if somebody has further questions, but it's excluded from Section 199A, and this is related to the 20% pass-through deduction that was passed recently in the last few years with the Big Tax Act. Because it's not considered an active trade or business for passive investors, it's ignored for the purposes of this calculation. The other thing to keep in mind is passive real estate investments. It's very common that they're going to throw off losses, tax losses, and that's because of depreciation. So depreciation is important to kind of have a general understanding of what is made up of the basis that creates the depreciation. So land is not depreciable, but building is depreciated over 27.5 years for a residential use property and 39 years for a commercial use property. And in some cases, you can get accelerated depreciation for the improvements. And the reason why this is important is because your cash flow from the property has to do with your rents and any maintenance and repairs and utilities and management and all of those things. And depreciation is a tax number. So you can have a positive cash flow and be having positive income coming in, but for tax purposes, you have nothing taxable. And so that's like one of the main benefits of real estate investing versus other types of investing. Now, I mentioned that passive can have a negative connotation. So this is where a lot of investors get stuck because they don't understand. Taxes, of course, we all know is complicated. There's several different buckets of tax treatment. So it's important to know what we call, what is the category of income that you're receiving for tax purposes. So you have ordinary income, that's what most people understand, which is income from your W-2 job, from a business that you run, things like that. So those are taxed at graduated rates. Those are ordinary income. You offset your itemized deductions or your standard deduction, and that's your ordinary income tax. Then you have passive income, and these are in their own little category. And so when I mentioned that your passive real estate investment can throw off a tax loss, that's great. It means you've got positive cash flow and you have tax loss. Those losses will only offset other passive income. So it's just important to know that it's in a separate bucket. I can elaborate more on this at the end for anybody that has questions. The other thing to keep in mind is that losses are limited to the investor's basis. when I'm talking about these passive losses, it's important to mention, to avoid any kind of panic. None of these things mean that you never get to take any losses allocated to you. It just means the timing of it is important to be aware of and talk to your tax advisor about. There's losses that can be suspended. When we talk about losses limited to investors' basis, that just means you can't write off losses if you didn't invest into the activity. So for example, you invested into an activity, you put in $50,000 and it throws off a $100,000 loss. Well, you can write off $50,000 to make it zero, but the rest of it is going to be suspended until you have some additional investment in the activity or you dispose of it entirely. That's generally what it means. And obviously it can get complicated, but that's the gist of it. You just have to keep in mind. Okay, and I know that last slide probably has a lot of questions on it, so I'm happy to elaborate on any part that was confusing. But I do want to move to the tax reporting summary. This just basically is a common thing that I see people getting confused about, is how are all these things reported to me? What am I supposed to do? How does it change my taxes? So in most cases, two things. So if you're investing in a real estate property, you're either going to have an additional schedule that has to be filed on your personal tax return if you are directly owning the property. If you are investing through an investment group, then you're going to get a form called a K-1. And the K-1, all it is saying that this person is an investor or a partner in this activity, and here's their share of this business activity for the year. So it will show your share of reportable income or loss for that year. It'll share of capital gains, which is typically only going to happen when a property is sold, but it will show that. It will show what the partnership shows as your distributions for the year, your contributions for the year, and it will also show a share of the non-recourse debt. And the non-recourse debt is basically the mortgage debt. It's basically just debt that's secured by the property itself. It's not personally guaranteed by anybody. Now, what I mentioned before, where you have your losses are only deductible to the extent of your basis, this share of non-recourse debt is important because this is added to basis. Just a quick illustration on that. If you had, in that previous example, you put 50,000 in and you had a $100,000 loss allocated to you. So without any debt, assuming that the property had no mortgage debt, you would be limited to $50,000 loss to bring your basis down to zero. You invested 50,000, you get $50,000 loss. Now you show that you have zero basis and you get to carry forward the other 50,000 in the event that you invest more money in the company or when it sells. The share of non-recourse debt means as the partner, you also get allocated how much a portion of the mortgage debt that the partnership will eventually have to pay on that property, and you get to treat that as basis because it's assumed that you are going to share in the payment of that debt. So that's one way where real estate is unique. Partnerships are unique because you are allowed to do this. We can talk more about that as well. I do have a sample of a K-1 if that's beneficial to talk about in a little bit more detail if somebody has a specific questions on what it looks like. What do you do with the K-1? So the K-1 is basically you give it to your tax person. If you do your own tax return, you need to input it into your tax software. It's important that it's entered correctly. This is a very, very common mistake that I see is K-1s not being input correctly. So two things, the K-1 needs to be correct, but then the input of the K-1 also needs to be correct. So it's a very common mistake. That information is reported onto your personal tax return. So it's important on the tax return to properly designate whether you're a passive investor or not, and to properly mark whether the activity has been disposed of. Have you exited it, or has the property been sold? So that you can free up any suspended losses. I can elaborate a little bit more on that in the Q&A if anybody has any specific questions. And that is all I wanted to talk about without knowing what you guys want to know. Because I could rattle off stuff and put you all to sleep if you wanted to, which wouldn't be beneficial for anybody. So with that, what questions do we have so far?
Oh, yes. Thanks, Claire. Really great stuff, by the way. And, I know I have some questions and some good stuff info out of that. And so we can jump to the Q&A, and maybe you can also plug your K1. I know that you have that one too, just to kind of have everybody's aware of how this K1 looks like, if ever that they're going to get one, or if they're going to go into a partnership, with some really good folks out there.
So this is obviously, can you guys see this K1?
I can see it.
Okay. So this is a blank one, but I'll kind of go through the main boxes you would expect to be completed if you're a real estate investor. So obviously here, you've got the partner name, you've got your information. This is important to make sure this is always correct, especially if this is your first year as an investor. Make sure your social is correct, because that is matched with the IRS. Make sure that they have the holding of how you're intending to hold the property. Did you invest with your family trust, or is it just you directly? Is it supposed to be husband and wife joint tenancy? So make sure that your partner information is correct. And then down here as a box G here, if you are, as I mentioned, a passive investor, you're not actively involved in the activity, you would expect to see this limited partner box checked. And then down here, you're going to have like a percentage of ownership. Here, this is generally going to be, if it's a large investment group, this is going to be, calculated by them based on, a share of contributions made into the partnership. Here's where I mentioned that non-recourse debt. You would expect to see the share of debt here being reported in box K. That's your share allocation. And then down here, this is also very important in box L. You want to make sure that this reflects your understanding of what you contributed. If you put in 100,000 that year, you expect to see contributed 100,000. Same thing with withdrawals and distributions. Does this tie back to what you show in your records? If this is not your first year, you would expect to see your beginning capital, and you would expect this to tie back to your ending capital on your prior year K1. So just little quick double checks that you can do to kind of catch problems from the very beginning if you ever have an error on your K1, and they do happen. Then as far as the box, now these are the actual items that will affect your tax returns. Generally in a real estate activity, you're going to definitely see something in box 2 if it's a rented property. And you're typically going to have not much else in the other boxes for a purely real estate activity. You might see some interest income if there's any interest-bearing accounts or a few little dividends. You also may see things down here. If the property's been sold, you would see box here, you would see capital gains being reported here. There's short-term, long-term gain boxes in box 8 and 9. You might see section 179 deductions when that's allowed. And you might see some sorts of credits if any credits were claimed on the property. And then here again, you would have your distributions. This is your distributions that you withdrew from the company according to what the company shows for that year. And does that help?
I think we lost you for the last 10 or 15 seconds. I'm not sure what happened. It's kind of going in and out. Let's see if we can get you back up here. Yeah, other people reporting that too.
Hey, Claire. Sorry. you just kind of got out of, I think, when you were talking about the number 5 here on this on the part 3, it kind of just went off.
Okay. Okay. So from here, the other important boxes would be capital gains. This would be when a property within the investment was sold, you would expect to see your share of capital gains to be reported or capital losses. Any tax credits that are being claimed and passed through to you. And again, this would be box 19 would be your share of distributions that you received during the year. So it's a good idea to just kind of glance through and just look for anything that looks off.
Sorry about that, everybody. Not sure what's going on there. It's just
When they take just a couple minutes to kind of glance over it themselves, a lot of times they'll save themselves a lot of trouble from having to amend a tax return later.
awesome. Thanks, Claire.
Mhm.
Lots of details and info in there. Lots of places to get lost, it looks like.
Yeah, it actually looks scarier than it is because typically when you get this, you're mainly looking at part 1, part 2. Does that look right? And then the step over here, there's typically only a few boxes filled in most K1s. It's not like, you know, we
Yeah.
occasionally get one that's like everything is filled out and it's a little scary, but
Yeah.
generally it's not.
Thanks for going through that.
Sure.
If you've seen that before, sometimes it's helpful just to, see something like that, get talked through before you get one in the mail. Go ahead and drop your questions in there, or if you guys want, just click the raise hand button. Make sure we'll try to unmute you there so that you can get your question asked the way that you want to say it. Are you seeing any questions, Princess? I know I've got a couple, if you don't see any over there yet.
Sorry, I was on mute, but let's get started with some, maybe as a passive investor, as a first-time real estate investing investor, some people might think about, okay, so this is the question: what are the benefits of real estate investing versus stocks?
Well, I mean, the main thing is with real estate investing, we know the history of real estate has, obviously there's downtimes, but historically it eventually comes back up. So there's the thought that it's a little bit less volatile than investing in the stock market, where, you could lose everything or you could hit it big, but most of the time it's somewhere in between. Whereas real estate investing is a bit more stable. You're kind of, you're investing in something tangible and something that in most cases is going to retain at least some of its value. Even if there's a drop, it's very unlikely to drop to zero. So that's one of the main benefits over the stock market. The other thing would be the fact that in some level you get to absorb your cash flow with your losses. Whereas when you invest in the stock market, that's not the case. Until your investment is completely gone and disposed of, you get no tax loss in the stock market. So you invest in a stock, it drops to zero. You don't get to write that loss off. If your portfolio drops 50,000, you don't get to write that off until you decide to completely cut your losses and sell that stock and give up that it's ever going to come back. Whereas real estate, you get the benefit of that depreciation right off every year that typically will wipe out your taxable income while you're still being paid out a distribution on the profits.
Cool. Thanks so much for that great info, Claire. We have one from Rodrigo Giraldo or Giraldo. Not sure if I'm saying it right, but apologize about that. Do you want me to go ahead and ask it for you, Rodrigo?
Please, thank you.
Go ahead.
Can you
Sorry. Okay. I think he told me yes. So he's a first-time real estate investor, and he's planning on building on an ADU for STR in the property where he lives. So how do I treat the income generated from the ADU? Can I deduct?
That's a additional unit, I'm assuming?
Yeah.
Okay. So, so with that, it's basically going to be treated as a separate line item. So you have, obviously there's going to be some shared expenses. Once the property is built, then you would take all of your cost that you incurred to build that property, say it's $100,000. You would determine we would add that up to your basis. So let's say it's $100,000. That's now your basis. That's what you're going to use for depreciation. So we talked about the depreciation that you get to depreciate it over 27 and a half years. So that gets added to your basis. That will be your depreciable basis. And then you will, at that point, once it's rented, then you're going to keep track of your rental income, and you're going to have to do an allocation of expenses. Some expenses will be self-explanatory because they're 100% related to that additional unit. And some expenses could be shared, like you might not have a separate water meter, for example, or you might have one trash service, or depending on how it's set up. So in those cases, you might have to split it out between the units. A common way that it's done is based on square footage. You would figure out the total square footage of both properties, what percentage of the square footage is the additional unit, and what percentage is the main unit, and then take that percentage, say 20% or something. You're going to allocate some of your home expenses to that unit that are not able to be separated. And then you're going to report all of that activity on a form called Schedule E on your personal tax return.
Okay. And there's a follow-up question. So I think it kind of also applies. Can I deduct any capital investment? This pertains to the previous question. Can I deduct any capital investment, which is loan to build the ADU, furniture, and the like, maintenance and other costs from the income?
You would, there's two categories. So the costs related to making the improvements are all capitalized. So those are part of your basis for depreciation for that 27 and a half years. So all the costs related.
Great, thank you.
Cool. Micah, do you have another question?
Yeah, I think, can we hear Claire? Claire, are you still there? Hopefully you can hear us. We'll give her just a moment here.
Depreciation rules that you can accelerate the depreciation for furniture and fixtures, appliances for.
Hey, Claire, I think we lost you again.
Claire. Sorry, everybody. We had this set up early and working great.
Sorry?
There we go. We just lost your audio for a second there.
I don't know what's going on with my audio. Okay. Sometimes I have problems with Zoom, so I don't know. Do you want me to try to call in on my phone and see if that's better?
I think we're okay. It's just in and out. I think he got his question mostly answered.
Maybe we can just like send the question to Claire, at that point, and then we could just like have Geraldo or Rodrigo get connected with her. I think that's way better.
Yeah, if you guys grab Claire's contact info, definitely do that.
Sure.
Awesome resource.
So we have a next question here. So it is from Scotty. He said that I have considered getting into wholesaling real estate. Can you elaborate on the tax implications of income from wholesaling?
Okay. So typically, I think I mentioned this a little bit on the whole. I don't think I have any additional information on the slides now. Okay. Basically, with wholesaling, it's going to be taxed similar to a fix and flip investor's activity, which means it is normally considered an ordinary business activity. So even if it's a side business that you're just kind of doing a little bit on the side and it's a part-time thing, you're basically acting as like a middleman. So you are helping to market a property, you're helping to connect the buyer and the seller. So you're really doing a business service. So the IRS in almost all cases will consider that a business activity subject to ordinary income. The same thing with a fix and flip investor. They don't get the same tax treatment as somebody who's a buy and hold investor. They're just different types of investors. Does that answer your question, or do you have some additional follow-up?
Oh, that's great. Thank you.
Sweet.
Okay, I have a personal question. So if I own a home, will I get more benefit from buying a second home or investing with a group?
I know that one of
Hey, Claire, sorry.
money deposit, like you might enter into a contract with the buyer.
Hey, Claire, sorry. Can I
Did I
stop
lose
you
it
for a
again?
minute? Yeah, you actually lost from the very beginning.
Oh, okay. Just on the follow-up part, right? Okay, so I was saying that with a wholesale investor, one of the things that attracts investors to getting into wholesaling is because it doesn't require a lot of cash outlay by the investor. Oftentimes the investor, the wholesaler, doesn't have to put any of their own money into the deal because they're connecting the buyer and the seller, and then they are getting a cut of the sale proceeds, kind of like a commission. And if they do have to put any money, a lot of times it's just an earnest money deposit to secure the contract with the seller, and then they then sell that contract to the buyer. Did you guys get that, or did it cut out again?
Yeah, we got that.
Okay.
Yeah.
Okay. I think the question was, will I get a benefit from buying a second home or investing with a group? I think that's another question that we have.
Yeah, so second home, it kind of depends on what you plan to do with it. So if it's purely a second home, like it's your vacation property, the only tax benefit is if you haven't already maxed out on your allowable property tax deduction, which we know now is limited for most people. And if you haven't maxed out on your mortgage interest deduction, you get to include that as if it was part of your main home. So you get potentially a larger itemized deduction. Now, if you are renting it out, whether it's a short term like an Airbnb situation, and you're using it for vacation and it's an Airbnb, then there's a potential benefit there because you do get to then take depreciation, you get to write off your maintenance and your repairs, you get to capitalize and depreciate improvements, just like any other rental property. So yes, there would be a benefit there. And then the other part of the question was investing into a group. The main benefit with investing in the group is basically you don't have to do everything. You don't have to be the expert. You do want to do your due diligence, to see whether this is what you believe is the best investment for you, but you don't have to go out there on your own and find the property and vet the property and manage it and all of those things. So a lot of that work is done by experts, and in most cases, people with a lot more experience in real estate and have learned from past failures and different ventures, and so can save you a lot of that drama in a lot of cases.
Definitely. We have another question from Rodrigo, follow-up. Does it make any difference from an income tax perspective if rental income is generated from an out-of-state property? So he live in California and have rental property in Utah. So would he be taxed based on California or Utah tax code, or both?
So California, of course, has got its own special rules for everything. So the short answer is no, it's going to be separated out. So basically, let's say you have a property in, I don't know, let's pick a state, Texas or something. It gets allocated, all your activity will get allocated to Texas. So it will not be taxed in California on the capital gain, but the income activity would be taxed in California. Not necessarily a bad thing because you're generally talking about tax losses. And then the other thing to keep in mind is that if you are holding the property in an LLC, this is a common mistake that I see real estate investors. A lot of times they have a real estate property, they want to hold it in an LLC for the liability protection, which is great, right? And it's pretty self-explanatory when it's a California property and a California LLC, you know you're going to pay the California tax. But when it's an out-of-state property held in an LLC but managed from California, California treats it like
we just lost you again, Claire. Let's give her just a moment here. Sure, you'll be right back with us. Great question, Rodrigo. I like where that was going. Claire, are you there?
yes.
Okay. Yeah, we just lost the last tail end piece, the climax there, that most important point.
That if you're managing it from California, is that the part?
Yeah, California sees that you're managing it from California.
Yes. So if you're managing it from California and it's in an LLC form, California requires you to register it in California as a foreign entity, and it is subject to the $800 minimum tax in California, even though the property is not in California and none of the rents are collected in California. Just the fact that it's managed from California, they want their $800, and they will eventually fine you. If somehow they will find out. It just takes time. Now, when you sell the property, it is not subject to California capital gains. It's going to be sourced to the state, but the activity, California wants their piece.
Cool.
We got a comment that yes, we love California.
Go ahead, Micah. Do you have a question?
Yeah, I was wondering if maybe you could speak a little bit more about the two different kind of income events in a passive investing situation where there's regular, maybe quarterly or yearly rental income that comes in, but then versus the sale of the property and the capital gains at that point. I understand you say both get reported on the K-1, but should a person expect to get taxed differently in each of those situations?
Yes. So they're all put in these buckets. So if you think of it as like little tax buckets, so the income comes in, what category does it go in? It goes in this bucket. This income comes in, and typically people have income sources from different, sources, right? So their job and their investments or whatever. So
Oh, all right. We'll give it another, I think it's like 10 seconds. Hang in there, everybody. Thanks.
Countdown. 9, 8.
You called it less than a year.
There we are. We lost you about 10 seconds there, Claire.
Okay. So
bucket. That's from every bucket.
Yeah. So you basically put it in, in the bucket. So the main buckets are going to be ordinary income, passive income, and these are also losses. So it could be the other way too. Passive income and loss, or capital gain, loss. And then within capital gain, you have long-term and short-term. So short-term, you held less than a year, and long-term, you held a year or more. So unless they change the laws, but they always talk about that. Short-term capital gains are taxed at ordinary rates, but you first got to put it in that bucket. Say it's a capital gain and it's short-term. Now it's ordinary tax. Long-term, now it's a graduated rate. Highest rate is 20%. For most people, that's less than the ordinary rate for the long-term capital gain. And then you have ordinary income, which is going to be taxed at your ordinary rates. That's the part that most people kind of get, because when you first start filing taxes, it's usually a W-2, taxed at ordinary rates. So that part of it, most people understand, and then they start getting confused when their whole financial situation gets more complicated and there's all these different tax rates. Passive is probably the most confusing. But if you think of it this way, if you put it all in the bucket, you might have some sources of passive income, some sources of passive losses. They can offset each other. So if you have another activity that's a passive investment, it could be a passive investment in a business. You decided to invest in somebody's business, but you don't work in the business. Or it's another passive real estate activity, and it has a passive taxable income, and then you have another real estate activity or another passive loss that comes through. You get to net those together, and if they wipe out each other, that's great. Or if it at least reduces the positive portion. But you don't get to take those passive losses and automatically offset your W-2 income. There's all kinds of special rules to make sure that people just can't do that easily. There are certainly some cases where that does happen, but it's a little bit tricky, and each individual tax person needs to, have their situation evaluated by a professional to just make sure that, are they going to be able to deduct overall net passive losses against other income or not for that year.
Cool. Thanks so much. And I think this also goes to the question that I have. So should I talk to my tax person before I make a passive investment, or what should we ask typically?
The main thing to understand is that if you are counting on being able to take losses to offset other income, then definitely talk to your tax person and make sure that is the case, and how much are you going to be able to take. So basically you want to do at least some sort of a basic tax projection to where they're taking into consideration all of your expected taxable incomes and losses, and figuring out what is going to be your total taxable income and at what rates. That way you don't have any surprises. If you are just looking at it as a pure investment and you're like, I don't really care whether I get the losses or not, I just think this is a great return, then not necessarily. Definitely let them know. But if there's any portion of it that you're doing it for tax purposes, definitely talk to your tax person first and make sure that your assumptions are correct.
Cool. And I think that's it. Do we have any more questions, Micah?
I think we're golden. If anybody else has any more questions, go ahead, drop them in the chat. I think we're going to start wrapping up here. Also, grab Claire's information. If you didn't grab it from the slide, you can reach out to us. Happy to provide that to you.
Okay. Claire, one more thing. Do you mind sharing how can people reach out to you, and what are the benefits? I'm sorry, what are the types of services that you offer?
Sure. Here, let me go back. Am I still sharing my screen? I think I stopped sharing.
Stopped it.
Yeah, let me go back to the information screen. Okay. So here's my contact information. Once you send me an email, then I can reply back, and in my email signature, I also have a direct Calendly link where you can directly schedule a meeting to where we can discuss any specific questions. If you feel like it's just a general question, you want to just email me the question, I'm happy to just reply back to that alone. But I do offer free consultation. So if that's something that's beneficial to you, I'm happy to meet with you to discuss.
Cool.
And as far as Terra Business Solutions, we're a full service CPA firm. So we do accounting services. We also have audit services and full tax services. So our accounting department does everything from, just quarterly bank reconciliations all the way to outsourced CFO services. We do specialize in real estate. although we do have lots of other business owners as well. And our accountants are also CPAs, so we don't have like low-level, inexperienced accountants doing our accounting work. We also have an audit department, and then obviously the tax department. We focus heavily on tax planning, so most of our clients do tax planning throughout the year. So I help them with their real estate investors. I help them run gain calculations, figure out, what their new basis will be on a 1031 exchange, help them, do tax, planning around their investments as well. Same thing with business owners. We do those services as well. And then of course we do tax preparation for them as well. So individuals, corporations, S Corps, C Corps, partnerships, trusts, all of those we handle.
Oh, great stuff.
That's awesome. Thanks, Claire. You guys, even if maybe you're not in a situation where you need that right now, I would really encourage you grab that information, because there's probably going to come a time where you can use that. And she's offering free chats. So I just went to your Calendly right now, Claire, and I booked 6 in a row. So you're going to see me for a few hours next week.
Okay.
Cool. Well, that's it for our Q&A, and thank you for all joining in. I think we're just gonna wrap it up real quick. Before we do that, we just wanted to invite everyone for our next webinar event. So that would be for, I think, give me 1 second. Let me just, yeah, it will be on March 9th. We will have our very own Mauricio Roque to go through the introduction of multifamily and what are the benefits that you can participate in, aside from the tax benefits that Claire just precisely discussed of all the details. So we'll send out invites in our Facebook group and emails. So make sure that you had signed up on our Brickstone Investment Group Investors Club. And don't worry if you haven't, just go ahead and click on our website, and also we will share you also those information since you had registered in one of these events that we had. So this is a free event. Again, feel free to share it with your friends and family about the good news. So also we are having our first in-person tour event on April 9. So every 9th of the month, we have some activities going on with Brickstone Investment Group. So we will just tour the investment properties that we acquired in LA, and you get the chance to see the opportunities also in multifamily investing and be able to meet and greet professionals in the business.
Yep, that's awesome. I know I'll be there. We also are closing just over 100 units in downtown Augusta, Georgia right now, so we won't take the tour bus that far, but we got a few good ones in LA, guys. Thank you all for joining us. Claire, again, thank you so much for your time, all this incredible information. That wraps up the webinar. Hope to see you guys at our next events. It's always a good time. All right. Have a good night, everybody. Thanks, Claire.
Bye. Bye.
Claire, bye. Just take yourself. Thank you.
Hi, guys.